Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jonathan Ferro, along with Lisa Abramowitz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.
Joining us now, the former senior Trump trade advisor, Kellyanne Shaw. Kellyanne, welcome back to the programme. The press secretary says it will work. Our question is, what will work? What is the ultimate objective?
Well, good morning. As I'm saying to most of my clients, happy Liberation Day to those who observe. The truth is we don't know, and I heard your last guest say that he has said, I don't know, 17 times, and I think that's where most advisors are at the moment. It could be a number of actions. It could be anything from reciprocal tariffs, where a series of countries have a number that's assigned to them that represents their tariff and non-tariff barriers. It could be a global sweeping tariff, or it could be some mix in between.
Kellyanne, what is the goal of these tariffs? What is the president leaning on at the moment? Because we heard that they're supposed to be revenue raisers, and at the same time, in the next breath, we hear people from the administration say that he wants to cut deals with some trading partners.
Yeah, from my perspective, I think the president has two primary objectives. So first is to address the longstanding trade deficit, that $1 trillion trade deficit that the United States has with a number of countries around the world and predominantly coupled in about 15 economies. The second goal is really about just this uneven playing field. And when I was in the first Trump administration, I heard him talk about this all the time, the fact that it was just fundamentally unfair that other countries had higher tariffs than the United States. And so I think he's looking to level the playing field. Now, he does talk about revenue as well, but to my mind, that really is a secondary concern. And I think he's really going after the brass ring, which is to remake the global trading system and to rebalance it in a way that more accurately reflects U.S. interests.
If that's the goal, and having worked for him and being a trade expert, what do you think is the appropriate prescription we might get from the president today?
Yeah, I think that the president is likely, and again, I heavily caveat this with nothing is final until the president says it so. I think he is likely to target those countries that are the worst offenders in terms of tariff and non-tariff barriers. We may see a more global measure applied to the rest of the economy, but I think he's going to be focused on those handful of countries. And to my mind, this kicks off a negotiation. This is not the end. This is not the certainty that I know a number of businesses and the markets are looking for. I think this gives other countries an opportunity to come to the table and say, look, we hear your concerns. We will cut some of these barriers too, and that the United States and those trading partners on a bilateral basis would begin to reciprocally lower their barriers.
Kellyanne, one of the questions I get asked a lot outside the U.S. is how many rounds is this going to be, and at what point do we know that whatever we offer sticks? How should we answer those two questions?
Yeah, I mean, one of the features of President Trump's negotiating strategy and his style is ambiguity, and it is very rare to get that kind of certainty. But what we did see play out during Trump 1 were a number of deals that were cut and inked, including the NAFTA renegotiation, which became the USMCA. We saw the Chorus Agreement renegotiated. There was a deal with Japan. There was a deal with China. So I do think that there is precedent for having that certainty at the end of what will be a rocky negotiation period. But I do think we're looking at the next several months to next couple of years with some of those trading partners before we actually get there.
Kellyanne, this raises execution risk, and people have talked about this repeatedly, that confidence among CEOs, CFOs, consumers has been falling off a cliff amid the uncertainty that may be a feature and may be prolonged over the next months and years. How concerned are you about this execution risk?
Yeah, I think two things are happening at the same time, and they're really in opposition to one another. On the one hand, the president is looking to reshape the global trading system, which requires breaking a lot of glass and not giving his bottom line. On the other hand, he's trying to attract investment from businesses around the world. And those two goals really require different strategies. So the administration is trying to land the plane on both. I think in terms of execution, the administration has an uphill battle. They're trying trying to do something that's never been done before. They're also trying to message this to the American people. And I think that whatever President Trump says at 4 p.m. today will be one of the most consequential speeches of his presidency, because he's effectively going to ask the American people for a long leash to allow him to negotiate some of these deals and fix some of these systemic issues. So we'll have to see how this plays out.
The press secretary said that some of these tariffs will be effective immediately. So do you expect tariffs using IEEPA or Section 338 to come out today and begin tomorrow?
Yeah, I think there are three types of legal authorities the president can use to impose tariffs effectively immediately. So IEEPA is one, Section 338 of the Trade Act of 1930 is another, and then there's also Section 122 of the Trade Act of 1974, which is about balance of payments. So he'll certainly have to rely on one of those. I don't know which one the president is going to use. I tend to think it might be IEEPA, but any one of those authorities would give him the ability to impose tariffs right away. Now, I will be looking to see what the executive order actually says and whether by immediately that means exactly at 12:01 on April 3rd, or whether there are a couple of days to give importers some grace or even a ship on the water exception, which is what we saw in the fentanyl tariffs.
I'm just pleased the announcement comes after the close now and not the original 3 p.m. that Secretary Bessent guided us towards. Kellyanne, appreciate your time. As always, the former senior Trump trade advisor, Kellyanne Shaw. Binky Chadha at Deutsche Bank writing, a credible relent on trade policy is necessary for upside risk to materialise. The clock is ticking. Binky joins us now for more. Binky, good morning, sir.
Good morning.
You're still at 7K year end?
Year end is a long ways out.
I agree.
I would just like to...
but if you're still at 7K...
I would just like to correct the record that, you know, I am not bullish near term. We expect basically the sell-off to continue.
Still bullish year end?
That's 9 months out. It's 3 quarters out. If you think about, you know, what happens if we have sort of a mild recession, let's say the second and the third quarter, you know, the tried and tested equities playbook would tell you that equities bottom in the middle of the recession. So that would be June 1st, recoup all of their losses, and that means at the prior peak by the end of the third quarter.
Just to be really clear, you think this year we could have a recession and still end the year at 7K?
I do believe so if it's a mild recession. That's actually what typical playbook would tell you. So where I would say, you know, the pushback in your tone is really, I mean, are we just going to have a 2-quarter recession? Are we going to have a recession?
To be fair, for somebody who comes out and has a 7,000 price target at a time when everyone's downgrading it below 5,500, and you say, well, I'm not bullish, you know, well, everybody else would look at it and say, you're pretty bullish.
So we're already at 5,600, so we're going to stay here for 9 months. I mean, the equity market's not good at staying in the same place, though I would point out that in Trade War 1.0, the equity market went nowhere, and neither up nor down, huge moves, but nowhere for 18 months, actually. So we are very well aware of that period, and it does play into how we think about things.
Is this predicated on the idea that some of the soft data is not going to be predictive of hard data, and that potentially you get some resolution in the near term, some clarity on policy, and potentially a Federal Reserve that helps out?
I would say not quite. What I would say is actually there's two, you know, distinct sources of basically soft data. I would say the low consumer confidence is not necessarily very predictive for what consumer spending and the business cycle is going to do, but consumer confidence is extremely important for presidential job approval ratings, and after an initial honeymoon period, you know, job approval ratings tend to go down to consumer confidence. And, you know, the way I would just note or remind is consumer confidence is exactly where it was when President Biden left. And so there's a lot of room for us to go down, and we would go down on bad growth news, bad inflation news, political developments. Now, I would say the other part of the soft data, which is CEO confidence, is extremely important driver of the actual hard corporate data and indicative of it. Now, we, you know, CEO confidence is tier 2 data, so we don't have very regular reporting and the like. But there are some measures that have basically fallen off a cliff. I mean, we're now below 2022 levels on the CEO magazine. We are European financial crisis 2012 levels. Whether that, translates to a good and comprehensive measure of CEO confidence remains to be seen. The measures all generally move, together. So there's every reason to believe it. Maybe not the extent and degree, but I think the biggest risk here is corporates go right back into the bunker. And once they go back into the bunker, they don't come out very quickly. So
what policies in Washington do you need to see to get to your year-end target?
That basically the tariffs are, in negotiation, a relent, just as happened in Trade War 1.0.
And you think it's wrapped up in 9 months?
I think, if there is a relent or rationality, if you want to call it that, we could get there pretty quickly.
So Binky, I want to take you away from your 7,000 target and ask you the question.
December 31st at 4 p.m. Yes, yes. Yes.
Over the last quarter, the S&P has underperformed the Euro Stoxx 600 by 17 percentage points. Which is remarkable. Some people think this is just the beginning, that we are going to have a normalization of valuations over the next few quarters. Some of it think it's overdone. Where are you on this?
We think it's got a long ways to go, basically. And really the issue is whether Europe can grow. We have, again, the cross currents that we've been talking about. We have the tariffs, as the negative. But, if I look at euro dollar, I mean, it's sitting right at 108, which is a very reasonable place to sit. So
if you believe that...
If growth starts to pick up, and I would say the ingredients for growth to pick up in Europe were already basically there before all of the German developments. So the German developments, are another positive and another reason to believe that growth will come. And if growth comes, we will get the earnings, and that's all that you basically...
But isn't that a problem for your S&P 7,000? Isn't that a problem that some of the oxygen now gets sucked out by Europe? Flows are no longer persistently to the U.S. The U.S. no longer sucks up global capital, and you lose a critical technical that has supported your bullishness about the S&P. Isn't that an issue for you?
At the margin, yes. But I mean, right now what I would do is I would be overweight Europe, which is what we are. And I would also overweight the U.S. I mean, remember that we're already down, around 8%. So it is looking better. And if you look at relative performance, tends to form in a channel. We have just moved from this U.S. relative to Stoxx 600. We were at the tippy top. We are now exactly the middle. That's why I say, we're just about
What are you underweighting?
There.
So you're overweighting everything. What are you underweighting?
No, I'm just looking at, that was about the S&P relative to Stoxx 600. In local currencies, we are right in the middle of the channel, so there is more room for the U.S. to underperform without really changing the trend. And so what has happened so far, the 17 point, that's half of, we're in the middle of the channel, so it can continue without basically upsetting the channel. But for the channel to continue, or for the channel to break, it's really about whether European earnings start to grow.
For as long as I've known you, for a long, long time, you've been bullish and right, and I've been skeptical and wrong, but this is the most bearish 7K conversation I've ever heard in my life.
I'm glad you didn't ask me what my 2026 target is.
What's your 26 price target?
No, I don't have one, so.
What gets us to 7K in the United States?
Look, the economy is still in good shape. We are closer to the edge. The risks have grown. There's no question about it. And there's no obvious large, big imbalance outside the U.S. government, I would say. And so it's all very possible, but yes, we are getting close to the edge and the risks have gone up a lot.
So what would make you turn bearish?
No relent on trade. Trade policy continues the way that it is, and just general lack of clarity in policies. I mean, what I'm saying is, if policy stepped out of the way, the equity market and the economy would be just fine. It is policy that is the big negative right now.
Is there a statute of limitations where there needs to be some clarity, before which the damage becomes more entrenched and you have to start to model it out?
That's exactly right. Yeah.
What is that statute? statute of limitations?
That statute of limitations is once, we get to a point in the slowing that potentially non-linearities start to kick in. If you look at the labor market in the U.S., it's a pretty delicate balance. It's been very, very steady, so I'm not sure delicate is the right word, but it is delicate behaviorally. It's just been stuck right there for quite a while in terms of hiring rates and firing rates. Both are at very, very low levels, so it is kind of stuck.
Binky, you're a good sport. It's good to hear from you, as always. Thanks for catching up with us. Binky Chadha there of Deutsche Bank. Seth Carpenter of Morgan Stanley writing, our base case remains that the focus of US tariffs will be on China. But if trade tensions escalate beyond our base case, the drag on corporate confidence, on capex and the business cycle will intensify. Seth joins us now for more. Seth, welcome to the programme. It's been too long, my friend. Let's talk about later at 4 p.m. Eastern Time. And I think more importantly for a lot of people in this market, how is the Federal Reserve going to navigate this moment?
Great set of questions, Jonathan. And it's, I think, the set of questions that just about everyone in markets is asking. First, the uncertainty here is huge. We've heard some more commentary out of the White House where they're clearly still resetting what they're going to do with tariffs. And so I think even inside the administration, there's some uncertainty yet. The Fed is left in this truly difficult circumstance where tariffs very clearly seem to push up price levels, which should boost inflation as reported in the CPI, all the regular data. My base case, as is the Fed's, is that inflationary boost is going to be temporary and should fade over time, but I don't think is going to be good enough for the Federal Reserve. I think it will be very hard for them to say, wow, this inflation will go away. I know because of my models that growth is going to take a big hit in 2 quarters or maybe into next year. So let me cut interest rates now despite inflation heading back up towards 3%. I just don't see them doing that. And so I think they're going to have to wait. Once we see inflation from tariffs start to kick in, they're going to wait on the sidelines with policy in their minds in restrictive territory and see how the tariffs play out through the economy. They're going to believe they'll be temporary on inflation. They're going to want that confirmed in the data. They're going to believe that it will cause the economy to slow down. But until they start to see it in the hard data, and make no mistake about it, the market has got the right answer here about a slowdown, but I think for the wrong reasons. There's not a ton of hard data yet that reveal the slowdown. I think all of that is still in the offing.
So it sounds like you don't really see a Fed put in the offing to try to really give a boost to both economic growth and confidence in markets, which raises the question about a policy put on the other side. What is currently being priced in? We were just talking with Mohammed El-Arian, who is here, and he said that he sees it as a 50-50% chance of a Reagan-Thatcher reordering of international trade versus Jimmy Carter on steroids. Markets currently pricing in about 80-20. What do you see?
I think it's very hard. When I talk to clients, investors around the world, there are as many views there as there are investors that you talk to. And so I think you can see the same asset pricing reflecting multiple different narratives. I think people just don't know. And so I don't think you can take anything for granted from asset pricing right now. I think it remains to be seen. I think the escalation scenario where the U.S. imposes some tariffs and then other governments impose retaliatory tariffs, and then we escalate from there. That really is a potential massive shift. And I don't think, as some people have said, it's just a question of near-term pain versus longer-term gain. I think if you get that escalation scenario, then you're just talking about fundamentally less productive economies around the world. It's not a zero-sum game. It could actually be a net loss for the whole global order.
Seth, let me put you on the spot, if I may. On Sunday, one of your competitors came out and they had 3 elements to their new forecast. 1, PCE inflation from 3 to 3.5% for the year. 2, fourth quarter on fourth quarter growth down to 1%. 3, the Fed cuts not twice but 3 times this year. What do you agree with? What do you disagree with on those 3 elements?
Yeah, so I think the main thing I would disagree with a bit is the timing. So we've got 1.5% as a baseline growth rate, but boy, lots of room for downside there. And that's a pretty conservative assumption on things like where tariffs go and how much this immigration restriction, which we should have a whole conversation about that. I think it is the most underappreciated policy from a macro perspective. But so 1.5%, 1%, I think both of those are very, very plausible. Direction of travel is just down for growth. Inflation higher from here, I think that's right. Our point forecast is a bit below 3%, but I can't rule out the higher number you cited. And for all the same reasons, tariffs could be stronger than we think. We could get more immigration restriction. I think the key difference for us is the Fed is in a very difficult situation. Data for U.S. economic activity lag. The Fed is going to have to pay attention to both inflation and growth. And before they start to cut in response to the slowing growth, they're going to have to accumulate enough information that says very clearly growth is a much bigger problem than inflation. That is very hard to do with inflation bottoming out and starting to rise back up, especially if it gets past 3%. I think you really need much more accumulated softness before Jay Powell and company are going to be ready to look through 3% or higher inflation.
Seth, do you see the market then as being wrong, pricing in 3 cuts by the end of this year, increasing that chance as the chance of some sort of weakening does seem to rise?
I do think so. I mean, the market has to price things on a probabilistic basis, and so there are lots of different scenarios implied in that price. I would say if you're relative to a straight reading of where the market is, they have too much priced in terms of cuts this year, nowhere near enough priced in for next year.
Seth Carpenter. Seth, appreciate your time. Thanks for making time for us this morning. Seth Carpenter there of Morgan Stanley. Here's a take from Julia Coronado of Macropolicy Perspectives, writing, "A recession has not become the baseline, though investors see the combination of Trump policies as a supply shock that the Fed's tools may not be able to address." Julia joins us now for more. Julia, you're super dialed into the FOMC, so let's get straight into it. Just from a cost perspective, by definition, the tariffs are paid by the importer. We've got that. How do you think the costs will be shared through the economy?
Well, it's going to be split between profit margin pressure and consumers' loss of purchasing power. And exactly how that breaks down sort of depends. We're not in the pandemic, so consumers they're not flush with cash. They're not just going to accept any price increase. And we've heard that in some of the comments to the surveys that have come in that businesses are struggling with how to pass that on. How much will consumers bear and how much must they absorb? But it's going to be a hit in either way. It's going to be a hit to profit margins. It's going to be a hit to consumer purchasing power. And it will come with a burst of inflation. And that's the problem for the Fed. They're already above their target, never got back down where they wanted to be. And it looks like it's going to be a while before we get there.
Julia, one argument is that this Federal Reserve is very aware of the scarring that takes place when unemployment rises to a certain level, and they want to cater to the economy first, even if inflation does run a bit higher. Do you think that this market right now is misguided in their understanding that the Fed could cut rates by 3 times, even looking through some of those one-time inflationary pops?
I think the tension right now in the market pricing, as far as I can see, is it's perfectly reasonable to think that the Fed might lean towards the unemployment mandate and cut 3 times, but that means the economy has to be really bad. It means that the unemployment rate's not just up a tick or two. It means it's risen and is rising beyond 4.5%. We're sort of heading into a recession. And they need to start insuring the economy. That is the scenario in which the Fed cuts 3 times. It's a perfectly plausible scenario. We're sort of leaning in that direction ourselves. We could see a rising chance that we could see a recession in Q3 or Q4 of this year. And it's not just about the tariffs. It's about the combination of policies. One thing that we don't discuss enough is the disruption from DOGE cuts and contracts and disruption to sectors that are usually very stable, like healthcare, like state and local governments, that may start feeling the pinch, and they've been driving job gains. So we could see a turn for the worse, and that could lead the Fed to cut. But that doesn't seem to be the sort of sanguine middle road that the market is pricing in terms of equities.
So I'm trying to understand, Julia, how hard are you leaning into? Because the dominant view right now, to the extent there is a dominant view, is that the soft patch is in the next few months. By the time you get to the end of the year, you have deregulation kicking in, you have favorable things kicking in. Whereas you said the risk of recession is highest in the third and fourth quarter, if I heard you correctly.
I have a very different profile from this idea we go through a soft patch. What drives growth up in the second half? Tax cuts. That's going to be that's a high bar because of the extension of the TCJA. You can play all the budget tricks you want. The reality of the macro impulse is that you're just not going to get that much fiscal impulse, very likely. And in fact, what we're seeing on the Doge front is that you're going to get a lot of disruption in fiscal policy, whether or not those contracts are ultimately paid. Cutting them off and injecting uncertainty across a number of sectors is likely to dampen their enthusiasm or willingness to hire employees. Deregulation, we constantly hear this. I can see that in the finance sector. I can see that potentially more M&A, less bank regulation, or at least a lighter touch. But where else am I going to see it? Energy, already we had massive production, low prices. In fact, prices are too low to get much more production. Where else? Tell me the channel that deregulation is going to boost the economy in the second half of the year. What sector benefits from this?
Julia, when it comes to this holistic approach, the Trump administration, tariffs, deregulation, tax cuts, what you're saying there is that deregulation and the tax cuts, which to your point really are just tax extension of current policy, aren't enough to offset what the investors view as bad policy or less optimistic policy when it comes to the markets of the tariffs.
Exactly. And then remember, we're not just talking about tariffs. It's uncertainty around the tariffs. President Trump likes to hold that uncertainty over other countries, over essentially the economy. And so it's not going to just go away today. That today is just another sort of step along a road of an ongoing trade war of tariffs and retaliation. Then let's layer on the Doge disruption to federal contracts. Then let's layer on the very restrictive immigration policy that is so draconian that it is leading a lot of workers, or at least some workers anecdotally, not to show up to work, not to engage in economic activity for fear of being snatched off the street and deported. And that has been, all of these things have been real tailwinds for the macro economy. The immigration piece is not insignificant. To go from an abundant environment of labor supply and growing demand to one where it's shrinking is a big shift in the environment. And we haven't yet seen that flow into the hard data, but I think the soft data is starting to pick that up. I noticed the comments to the Dallas Fed service sector survey yesterday were very interesting along these lines. They talk about the hit from immigration. They talk about what it's going to do in terms of constraining the construction sector. So, in Texas, we feel that. It's very direct. So, I think these things are going to come forward and show up in the hard data. And we're just focused on tariffs, but there's a whole range of policies that are not growth friendly.
It's a lot to get through. Julia, appreciate your perspective. Thanks for joining us. Julia Coronado there of Macropolicy Perspectives.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.